Hey everybody, welcome back to our monthly market commentary. I'm Brad Gotto, and here with me, as always, is Mr. Tim Holland. Welcome back, Tim. Welcome to 2026.
Good to see you, Brad. Welcome to 2026 indeed. Happy New Year. Brad and I were talking pre-recording. It's a little nippy here in the east, but I guess we've got nothing on
And
the
I
great
said
state.
that's cute.
Yeah,
That's
we've got
cute.
nothing
Yeah,
on the great
'cause
state of Minnesota because the high this week is like on Friday,
on
negative
Friday,
something.
yeah, -10. Those are always
Wow.
the best days when the warmest part of the day doesn't
It's a
feel well
negative,
zero.
yeah.
Yeah.
Hardy
Yeah, I don't,
stock. Hardy stock out
man.
there in the Midwest. You
See,
guys are tough.
that's why I'm overweight. That's why technically, I'm very responsible, Tim.
Very
That's what
smart.
that's what it's
You
for.
need that extra layer come the winter months. Anyway, good to see
Yeah,
you.
I
Good to see you.
we live here by choice. I don't understand it, but we do, and so here we are. But welcome to 2026. If this is your first ever monthly market commentary, I guess I didn't disclose. I'm the founder and CEO of Fiat Wealth Management, and Tim is the Chief Investment Officer of Town Square Orion. I MC, and Tim is the brains of this operation, and so we're going to attempt to give you all just a little insight, kind of our cadence on a normal monthly market commentaries. We'll take a look back over the last month and kind of discuss a major point that's worth discussing, and then I look forward to the coming month and something that we're paying attention to, and then an interesting point or just kind of a fun data point that's worth discussing towards the end. So let's jump right into that, and let's look backwards first. This point, Tim, I'm calling trophy class or dud. I grew up in Iowa, and in Iowa there's a lot of cows. More pigs. I don't think Iowa wants to admit that, but we have more pigs than cows. But a lot of cows, and my wife's family has some pretty high end cattle farms, and so when you're out there looking for a bull, there's a lot that goes into that, and making sure that you get a good one and that it's structurally sound and sturdy and all the things.
Yep.
My question for you is the current bull run that we're on
Yeah.
just hit an anniversary.
Yep.
And the question becomes, do we have a trophy class kind of bull run in front of us, or do we have a dud? Because I'm not poo-pooing, so to speak, very technical language there. The fact that we've already ran as far as we have, and I don't want to give away the numbers, I'll let you do that.
Yeah.
But we're still not in what would be considered trophy class bull territory. And so can you talk a little bit about how far into this bull run we are, and does it have the legs to get us from kind of a mediocre bull to a trophy class Angus cow, if you will?
Okay. No, I grew up in New Jersey, so I have no experience with championship bulls. So one, it's always great to just talk market.
Interestingly enough, though, there's
Yeah.
a type of cows that are Jersey cows. So
Yeah.
that's a type of cow.
There you go. And so it's always great talking markets and economy with you. But I just learn a ton from these conversations. So that's good.
Yeah, all the stuff that doesn't matter. That's what's stuck in my head.
No, it's good stuff. I use it. I use all of it, Brad. Just trust
Yeah.
me. So to your point around the markets, and not to poo-poo, technical term, the current bull market, but as great as it's been, right, the S&P was up 18% on a total return basis last year, did even better the prior 2 years. Not to be dismissive, but there's kind of nothing extraordinary yet about the current bull market that we're all living through and is still going
Yep.
as of today. And so to your point, the bull market turned 3 years old fall of last year, so it's in its fourth year, which is fantastic. As to whether or not that can continue over the last 75 years or so, for what it's worth, at the risk of jinxing it, 6 of 7 bull markets that entered year 4 made it to year 5. So the odds are overwhelmingly on the current bull market's favor that we'll still be in good shape come October of this year. That'll be the 4th anniversary, sort of knock on wood. And then even though the gains have been extraordinary, or well, actually not extraordinary relative to history, but have been very, very strong, the current bull market has run, for about 39 months now, has returned about 90% all in. If you go back, 70 years or so, not as far back as 75 years for the 6 or 7 bull markets, but if you go back to the mid-1950s, The average bull market has run for 57 months, so closing in on 6 years, and returned 159%. So as great as the gains have been, not trying to be greedy, never want to be greedy, want to be grateful. But as great as the run has been, it hasn't entered that sort of Angus bull
trophy
elite,
class
sort of stratosphere yet. But if history's any guide, it should. If earnings can hang in there, interest rates can continue to move sideways to down. Obviously, a lot of geopolitical risk and uncertainty, but we've lived with that for a while now. If history's any guide, we'll, knock on wood, we'll be sort of celebrating the bull's 4th birthday come this October, and we should see greater gains and greater duration of the current rally.
So there's 2 things that I just want to point out to the listeners that you brought up there. The first one is essentially what you're saying is that if history is a guide, we have more legs.
Yeah.
Like if we make it this far, it tends to be we got more room to go, which is, again, doesn't mean it's guaranteed, doesn't mean that it's not going to turn sideways. But again, using history as that guide, over the last 6 to 7 bull markets, that's the way that it's gone. I think it's purposeful that you used 6-7 because that was also a big part of 2025.
Kind of walked into that one, didn't I?
You did. 6-7 is there. What's interesting is the other point that I just wanted to make before we kind of look forward is, as great as the bull run has been, one of the questions we have started to get, Tim, from clients is, when they look at, everybody watches the S&P. It's the normal, most broadly understood, watched index probably in the world, right? Yeah. Given the fact that 54% of all money invested in public markets is here, something close to that. I don't remember if that's the number anymore, but it's close there. That diversified portfolios aren't returning what the S&P is returning. Because although there's some asset classes that actually outperform the S&P, we also have bonds, albeit a great year last year, at about a 7% clip. Small and mid-cap markets, 6 and 7% respectively. There's that dang number again, 6-7. Yeah. So over the last 6 to 7 bull markets, we've got mids and smalls doing 6-7. So diversified portfolios, on the whole, although great years, still not returning just your pure, large cap growth type returns. But again, doesn't mean you shouldn't stay diversified. Doesn't mean you should run away from these asset classes. Stands to reason that when one falls, the other one kind of stands up, and so diversification still is really important. It's just really hard to be. What makes me think of is diversification is kind of an insurance against catastrophic loss. Yeah. And anytime you buy insurance, and I just went through this. I just went through the full audit of my property casualty insurance, Tim. It was very painful because my homeowner's premiums just kept going up, and over the last 2 years, they basically doubled.
Wow.
And so it was the whole frog in the boiling pot of water. The pain finally got big enough that I was like, you know what? I gotta do something about this. So just went through the whole audit, changed everything around. And the homeowner's premiums, I hate paying them. I hate it. And it's one of those deals where every year that goes by that you paid for insurance and you don't use the insurance, you're second guessing, like, gosh, should I have done this? The insurance of diversification to the long-term investor is proven worthwhile. It's just in times like this, when you've got segments of the market that are running as hot as they are, that insurance looks foolish in the short term. And so just an encouragement to people as we look backwards, not to use that as an excuse to get rid of that insurance policy of diversification, but to try to stick with it.
No, I think that's great advice, great perspective, and at the risk of getting too short term in my comments right now, if you think about some of the geopolitical headlines of the last couple of days, U.S. equities, we're recording this on the 21st of January, you may have mentioned that, fell pretty sharply yesterday, some concerns around sort of Greenland and the U.S. and European relations and trade. The S&P 500 is about flat now year to date, gave back those gains. Small cap stocks are up over 6%. So you're seeing some of that offset.
Maybe 7.
Yeah, maybe
7.
Maybe 7. So you're seeing some of that offset, and that's pretty funny. And then as I think about investing, and not to tell anyone how to think about their own portfolios, benchmarks are great. It's good to kind of measure what you're doing and how you're doing. But ultimately, I think about my portfolio. I don't have the S&P in mind. I don't have the Russell 2000, which is a small cap index in mind. I don't have the Bloomberg Aggregate, the bond index in mind. I have a pile of money that I've worked pretty hard, I think, to accumulate. And I'm just trying to think about what I need it to do for me over the next 10 or 15 years as I get older and closer to retirement. And that's the number I work off, and work with a financial planner advisor to kind of build a portfolio that hopefully gets me there in as smooth a way as possible. You know, what do I need the money to do for me? And for me, at least, it's not about beating an index or not.
Yeah. Well said. Let's get off the 6-7 train and on to a look ahead, because hopefully that's dead. I killed it in my house, by the way. And the way that I killed it was I just kept doing it to my boys, to the point where it wasn't cool anymore. If Dad's doing it and Dad thinks it's funny or cool, then it's not.
Done.
So
it's over.
That's how I got rid of it. Was
there
I just leaned way too far into it. All right, I'll look ahead. I'm calling this point, Tim. Is this video AI or is it real?
Wow. Well, if it was AI, I hope I'd look a lot better. So I'm just, if we ever go to AI, just make me look a lot better, okay?
The point of AI is not to make people think it's AI. We can't do that, Tim, because then they know it's not real.
Oh.
That's not.
All right.
So take the gray out of my beard and all that stuff.
No, you look good. It's distinguished.
Yeah.
It looks good.
I appreciate that.
Yeah.
So all that to say, with AI, it's been a big talking point. The concern of the negative of it kind of taking away jobs and things of that nature. What I want to talk about is, as we look forward, kind of what is the positive side of this for us, and where's the silver lining as an investor? What should we be looking for?
Yeah. And AI, engenders very strong emotions. To your point, it's going to ruin the job market or parts of the job market, maybe for younger folks coming out of college, or what it will produce. The content will just kind of continue to tear at the social fabric. And so I'm not being dismissive of that, or it's so revolutionary, it's just kind of too soon for any of us to sort of comprehend, or maybe it's all a big whole lot of nothing. And so I'm not being dismissive of sort of how people feel about it and how they react to it, or the risks associated with it. But if you want to be optimistic around AI and what it might mean for the economy and for all of us as investors, there are two things that get an economy growing. As you know, it's people and productivity. And we're older than ever as a planet, as a country. So demographics, I certainly feel it here in 2026. So the demographics are still okay for us in terms of people entering the workforce. We're in a much better spot than most other major economies. China's workforce population has already begun to shrink along with its overall population. So you need people kind of working, and then you want them to be productive. Hopefully they enjoy their work as well. And so Q3 GDP came in, gross domestic product growth was well above expectations. And the number that kind of blew me away under the headline was that productivity grew 4.9% in the quarter. So that's, broadly speaking, all of us as workers were 5% more productive year over year, which is a huge jump for an economy of our size and of our age, and the workforce's age. So again, I'm sure there are downsides to AI, but we seem to be early in maybe a productivity boom, the likes we haven't seen in over 25 years. AI could be accelerating that. And if that does take off, it should mean greater economic growth, greater corporate profit growth, but hopefully not much pressure on inflation, which would be kind of the best of all possible worlds for the stock market. So again, always risks, always concerns with any new technology, but AI could be sort of supercharging this nascent productivity boom, which would be a huge deal for the U.S. economy.
Yeah, I'm sure all of you listening have pretty strong opinions on this because it's all over the news right now. And regardless of your opinion as an investor, if you just kind of put your investor hat on, obviously pretty large opportunities. We've talked in previous monthly market commentaries just about the companies that are investing the most money and how well capitalized they are, and this whole concept of the risk of them spending so much money that it's negative, and comparing it to the dot-com bubble. I'd encourage you to go listen back to the previous monthly market commentaries where we kind of unpack that. But I'll just tell you personally, Tim, it's adding a lot of efficiency to me. Where commas go versus periods, how to spell words, and all that kind of stuff. It's adding a ton of productivity to my life. So I've personally experienced far more than a 4.9% productivity growth for me. So I don't know how much you're using AI these days, but
no, we are as a team and as a firm, and we're trying to use it to drive a better client experience.
Yeah.
Kids are, I've got a freshman in college. I've got a sophomore in high school. Their schools have set parameters around the technology. They're all in on it as well. But it's funny when you said what you said about sort of spelling words better. For some reason, remember that movie Zoolander?
I do.
With Ben, the Derek Zoolander Center for Kids Who Can't Read Good. Anyway, that's just what came to mind. That's what came to mind.
Little levity in a situation there.
Yeah.
So, but put that in perspective, 4.9. I just want to end with this before we go to this interesting point here as we wrap up. To your point, the size of our economy, how much our GDP is, and you add productivity levels, even at a 1% clip, increase in productivity is massive.
That's huge.
When you're moving a machine the size of our economy, and you add any level of efficiency or productivity, it dramatically changes the game. And so those numbers to me are just staggering.
Yeah. Sure.
So, all right, a data point or an interesting point worth discussing. I'm calling this point, can he do that? We've just got a lot of it, and I guess it's not unique to January. But here we stand again with that kind of lingering question with the existing administration. And again, this isn't a political statement about the administration, but we're running into another instance of hey, from the Oval Office, can he do that? And specifically right now, it's this idea of tariffs again are now in the news. And so I want you to unpack that for us a little bit. And then, of course, the firing of the Fed Governor Cook. And so, to my knowledge, we don't have decisions on either one of those things yet. But let's start with the tariffs. Kind of what's the new lay of the land, or kind of the latest on the tariff front, what was proposed, and then what is the decision that they're looking at relative to the current administration being able to make those decisions?
Yeah, so it's Wednesday the 21st. Monday was a holiday, Martin Luther King Day, so it would have been the 19th. Obviously, yesterday the 20th, markets stumbled pretty meaningfully here at home. The dollar sold off a little bit. Bonds sold off as well. I apologize. I'm getting over cold, so I popped a lozenge in. But the administration...
You're showing your age by calling it a lozenge,
apart.
just to be clear.
Should I call it a cough drop?
Yeah, I mean, unless you got grandkids, sure, then it's a lozenge.
Lozenge just is classier.
Do you need to go home and sit on the Davenport and take a nap? Like, is that...
I'm going to put my galoshes on over my shoes, take another lozenge, and then go home. And take a nap. Thank you very much. With my V-neck sweater on.
Yeah.
He's a fan of the V-neck sweater as well. So over the last couple of days, clearly the administration has a deep interest in apparently acquiring Greenland from a national security and a sort of precious metals and a commodities point of view. That's not new. I think the level of interest and the intense focus on Greenland has caught some folks in our business off guard. And then over the last couple of days,
I think that's an understatement, to be clear.
Yeah. I mean, it's something they've talked about, but the fact that they keep coming back to it, I think, to the extent that they do, with a seriousness of intention, has caught a lot of people off guard. Along those lines, the administration has essentially said, if they're not more or less, if we, the U.S., are not more or less given Greenland, there will be economic consequences. One would be new tariffs on the UK, the EU. Set aside the trade deals that were struck last year. One level, I think, believing starting February 1 and then ratcheting higher from there. So that also caught people off guard. So the focus on Greenland and then some of the proposed tariffs. To your point, the Supreme Court, I think, just finished up oral arguments around the president's ability to impose tariffs under the International Economic Emergency Powers Act. I don't think what has been proposed around Greenland, there's not much in the way of specifics. Donald Trump or the administration, I don't think, has cited the IEEPA. They've just put those out there. A lot of folks who think, not to get in the politics of it all, that the administration has gone too far with trade and tariffs have essentially said, if the executive can just sort of gin up tariffs at will, declare an emergency, slap tariffs on trading partners and move on, there's really no constraint on the executive from a trade tariff taxing point of view. And if the Supreme Court decision wasn't already important, it's even more important in light of the Greenland news. So we could get any day now word from the Supreme Court that essentially the administration can do everything they've proposed, can do none of what they proposed, or somewhere in the middle, and that will also impact what they're talking about doing with Greenland. My best guess is the Supreme Court's going to come out and will push back against the administration, maybe not in total, but in a meaningful way. The administration will then either ignore the court's ruling, which I can't imagine they would do, and I'm not here to play politics, I can't imagine they would do that. They would look for another way to keep tariffs in place or propose and then put in place new tariffs. But the other tools at their disposal are much less broad, much less powerful than the IEEPA. So I think the administration is going to lose that case. I think they will try and figure out a plan B. It won't be as sweeping as what they've already done. My best guess is, like or dislike the administration, agree or disagree with what they're doing around Greenland. That will add to uncertainty around trade and tariff policy near term, even more than what we've already seen, but should then provide some sort of playbook for the administration and future administrations on a go-forward basis, which I think would be welcomed by Wall Street. And then today, the Supreme Court will hear arguments in the case of Fed Governor Lisa Cook, and the administration's desire to remove her for cause. Again, that's early, but my best guess is the administration will lose that case as well. And I think there it becomes more of a non-event, partly because Chair Powell's term is up in May. The administration will sort of move on. But those are the two big cases. And so the Supreme Court rulings were going to be big anyway. In light of Greenspan, the trade case is an even bigger deal than it was, if that makes sense.
Yeah. All that to say, we obviously don't know.
Yeah.
I think we're all still kind of on our heels a little bit about just this concept of, I don't call it whatever you want to call it. This isn't, again, I'm not taking a stand on this, but kind of a takeover of another country. What's interesting to me is celebrating 250 years in this country. You would think that by now, all the decisions that need to be made relative to kind of like the plumbing and the wiring and the rules and the laws of this land would be done. You would think that like we've gone through it all. Yet here we stand, and we're constantly having to bring things to the Supreme Court and make decisions, new laws, new rules, new regs. It never ceases to fail. And so just when you think, everything that can be done is done, we end up with Supreme Court decisions around essentially just the takeover of another country. And I'm not laughing at it to make light of it, because I know it's kind of a big deal, but it's just mind-blowing to me.
That's a good point.
So it's going to be an interesting year, Tim.
It's going to be an interesting year, Brad. I'm looking forward to talking to you about it as we go. I'm going to have a good supply of lozenges. I'll have my galoshes, my V-neck sweaters, and my afternoon naps. So I think I'll be okay. I'm going to manage okay. I'm going to try and manage okay.
I love it. Tim, it's always really good to see you. In spite of your cold, I appreciate you being here with us anyway. Interesting kickoff to the year. We got a lot to talk about. It's going to make these monthly market commentaries full of good fodder, so to speak. So thanks for being here. As always, listeners, again, appreciate you joining us for a monthly market commentary. Tim and I are here each and every month, just kind of trying to deliver at a 50,000-foot view a little bit of information, sometimes some levity into the situations that are going on, but always perspective. Because at the end of the day, financial plans aren't built for month over month, and although we're coming to you month over month, they're built for the long term. And the hardest part about being an investor is staying an investor. And the hardest part about developing financial plans is sticking with them. And January is a great month to remind ourselves of that, because New Year's resolutions are a very, very popular thing in this country. And unfortunately, they've dubbed January 9th quitting day, because that's how long the average New Year's resolution lasts. It's 9 days.
9 days.
So don't feel bad or different in the fact that sometimes you're questioning the long-term viability of planning, because it's a natural human response to volatility and things that are going on around us. And so, again, thanks for joining us. We'll be back with you in February. Tim, thanks for being here, and we'll see you all next month.
Take care.